April 1933. Nearly every American was forced to hand over their gold by law, in a government move that instantly generated billions in hidden profit. Today, the official story says it cannot happen again. But with $500 billion in private gold at stake and no independent audit in 70 years, could the same machinery be quietly waiting to strike once more? Let us find out how close we really are. April 5th, 1933. President Franklin Roosevelt signs Executive Order 6102. Overnight, it becomes a federal crime for most Americans to own gold coins, bullion, or certificates. The language is sweeping. Every person in business must deliver their gold to a Federal Reserve Bank by May 1st, except for a few small exemptions like jewelry or rare coins. The penalty is up to 10 years in prison or a $10,000 fine, a staggering sum in the depths of the Great Depression. Banks and newspapers publish notices. Citizens line up with bags of coins and gold bars, trading tangible wealth for paper dollars at the official rate, $20.67 per ounce. There is no negotiation, no market price. Bankers, shopkeepers, farmers, anyone with savings in gold face a stark choice: comply or risk prosecution. Compliance is widespread, driven by fear, patriotism, and the relentless pressure of the banking system. Some hide coins in walls or bury them in backyards, but these are exceptions. Across the country, vaults fill with surrendered gold. Congress quickly follows with the Gold Reserve Act of 1934. All gold held by the Federal Reserve is transferred to the U.S. Treasury. Then, in a single move, the government redefines the dollar. Gold is now valued at $35 an ounce. The revaluation is not a minor adjustment. It is a 69% jump. The gold just taken from citizens and the Fed is suddenly worth far more, but only for the government. The profit, about $2.8 billion, flows straight into the Treasury, funding the new Exchange Stabilization Fund. In today's dollars, that windfall would approach $70 billion. Legal challenges come fast. Bondholders, railroad investors, and ordinary citizens sue, arguing the government has destroyed the value of their contracts and seized their property. The Supreme Court hears the famous Gold Clause cases in 1935. In narrow 5-4 decisions, the court upholds Congress's power to cancel gold clauses in both private loans and government bonds. The justices acknowledge the government broke its own promises, but rule there is no remedy. Once Congress changes the law, the courts cannot enforce the old gold standard. Overnight, millions of contracts are rewritten. Ownership, value, and legal rights all reset by emergency decree. For the next 4 decades, private gold ownership remains illegal in the United States. The machinery of seizure and revaluation is now part of the legal record. The precedent is clear. In a crisis, the government can rewrite the rules of ownership, and the courts will not stand in the way. Officially, the United States claims to hold 8,133 tons of gold, the largest national reserve in the world. The gold is said to sit in guarded vaults at Fort Knox, West Point, the Denver Mint, and deep beneath the Federal Reserve Bank of New York. Yet the public has not seen a full independent audit of these reserves since 1953. In more than 70 years, no outside investigator has been allowed to count, weigh, and assay every bar. Instead, the Treasury conducts periodic internal checks, releasing summaries that offer little detail. The chain of custody for these bars, many stamped with pre-war dates, remains largely undocumented to the public. Meanwhile, the Federal Reserve's balance sheet has ballooned to nearly $7 trillion. Decades of monetary expansion, crisis after crisis, have flooded the system with dollars, but the official gold stock has barely changed since the 1970s. The gold remains on the books at a statutory value of $42.22 per ounce, a number frozen since the Nixon era. At current market prices, the reserve would be worth over $600 billion, but the official accounting obscures the true scale. Calls for transparency have grown louder. Lawmakers have introduced bills like the Gold Reserve Transparency Act demanding a comprehensive audit and public inventory, including the full transaction history of every bar. These proposals have stalled in Congress, leaving the audit vacuum intact. No independent agency, no outside auditor has confirmed the existence, purity, or ownership of the nation's gold since Eisenhower was president. This opacity creates a vulnerability. In a system built on trust, the absence of proof invites suspicion. The Federal Reserve and Treasury insist the gold is there, untouched and unencumbered. But without verification, the public can only take their word. As the Fed's liabilities multiply and the dollar's foundation grows ever more abstract, the question lingers: if the gold is truly there, why not prove it? Decades of secrecy have left the door open to doubt, and in times of crisis, doubt can become a weapon. Rumors of a modern gold confiscation plan often trace back to a single number: $454 billion. In March 2020, as markets crashed and panic spread, Congress rushed through the CARES Act. Buried in its hundreds of pages was a provision that authorized the Treasury to backstop Federal Reserve emergency lending with $454 billion, close enough to $500 billion to catch the eye of conspiracy watchers. But the real fuel for suspicion came from a temporary exemption. During the pandemic, the Federal Reserve Board was allowed to meet behind closed doors, waiving normal Sunshine Act requirements. No advance notice, no detailed minutes, only basic records of votes. Critics in Congress warned this carve-out could hide sweeping decisions from public view. For months, the Fed approved new lending programs in secret sessions, ultimately committing trillions of dollars to stabilize banks and corporations. The secrecy was legal, but it left a vacuum. Online, the $454 billion figure morphed from a public emergency backstop into whispers of a hidden confiscation fund. Social media posts cited the CARES Act as proof of a shadowy plan, but the statute itself only covered pandemic lending. When the waiver expired at the end of 2020, the Fed released transcripts and records showing deliberations focused on liquidity, not asset seizure. Still, the combination of massive sums and temporary secrecy proved irresistible to those searching for evidence of a modern gold grab. The gap between what was authorized, what was discussed, and what was imagined became the breeding ground for the next wave of speculation. Presidential emergency powers today reach far beyond what Roosevelt wielded in 1933. Under the International Emergency Economic Powers Act, the President can freeze and seize assets tied to any declared economic or national security threat, no court approval required. The Defense Production Act allows the government to prioritize and even requisition strategic materials, including gold, from private hands or industry. Section 13. Subsection 3 of the Federal Reserve Act lets the Fed, with Treasury consent, create emergency lending programs or asset facilities that can target banks, corporations, or entire sectors if they are deemed systemically important. These statutes remain active, tested in financial panics, wars, and even the 2020 pandemic. The digital age adds a new layer. Central bank digital currency pilots like Project Hamilton are built on centralized ledgers and identity-linked wallets. Every transaction can be tracked, frozen, or reversed by code. If a crisis hits and gold is flagged as a strategic asset, the technical infrastructure already exists to monitor, block, or force the exchange of digital claims instantly. Banks, ETFs, and vaults could be ordered to suspend withdrawals or transfers. Individual wallets could be locked until compliance is verified. The pool of potential targets is vast. Private U.S. gold holdings are valued at $250 billion to $400 billion. Add $150 billion in ETF reserves and $50 billion in silver, and the sum approaches $500 billion, enough to backstop a currency reset or fund a new stabilization program. A single presidential declaration citing inflation, a banking panic, or foreign sanctions could activate the machinery. The legal pathway is already paved. The digital overlay means enforcement would be swift, silent, and total. Today, $400 billion of private gold in the United States sits unverified, while emergency powers and digital enforcement tools have never been stronger. As financial crises grow more frequent, the line between protection and control blurs. In the end, the real risk is not confiscation. It is complacency. What would you do?